Welcome, everyone. Thanks for joining us today for the industry panel on lumber futures. I'm Beth Helberg, Marketing Manager with BuildExact. A few housekeeping notes before we begin. The webinar is being recorded, and we will share the recording with all registrants. If you have any questions, you can add them to the chat, and the panel will address them towards the end of the webinar. We've saved some time for questions. I'm really happy to introduce our moderator Russ Kathrein with Do It Best. Russ, I'm going to turn it over to you.
Thank you very much. Appreciate it. Today on our panel, well, first I should say good afternoon, everyone, but on our panel, we have two industry experts. We have Materials Exchange co-founder and CEO, Mike Wisnefski. Mike, raise your hand so we know there. And we have the owner of Deacon Lumber Company, Stinson Dean. There you go. So let's, Stinson, start with you, and then we'll go over to Mike. So 2022 has been a crazy lumber year, as was last year, the year before. What are your thoughts on 2023?
Oh, that's a good question. So it's the popular concept through the past 24 months was a bullwhip effect. This idea of just these reverberations and then slow making their way through the global supply chain and then slowly kind of evening out. So I think I think we're through the worst of it. The worst being volatility, the worst being lack of kind of stable pricing. Everyone's scared to put a number on something because what if, and this range of outcomes that folks have had to price in to the home buyer, to the builder, to the lumberyard, all the way through the supply chain. That range of outcomes that I think has shrunk to a point where we're working our way into a new normal. I think we're going to stay higher for longer compared to pre-COVID. But you know, for 2023, I would say, to sum it up, less volatility than the past 2 years, but a higher base price than any housing cycle prior.
Okay. Mike, what about you? What's your opinion on that?
I agree with what Stinson said, but from the volatility standpoint, I think it's going to be lower than what we've just experienced, but much higher than our recent or our historical volatility. You know, one of the things that added to that volatility was when everybody got in sync. COVID was the great reset, and everything just stopped and then restarted at the same time. And all the buying and everything basically, like I said, got in sync. I don't think we have unhinged from that yet.
Interesting.
And, you know, the other thing is that on the supply side, the financial health of the suppliers is really good right now. So it's going to allow them to make decisions quicker and more easily. They don't have to run for cash flow. Like, as crazy as it sounds, some of these big corporations had such a debt load, they used to have to run just to pay the debt because they needed the cash flow. Now they don't have the debt they had previously, so they can be more nimble. And I think, you know, this is the old everybody on the same side of the ship, making it tip. I think people are going to more quickly move to the sides of the ship. So the volatility is going to be not as size-wise dramatic, but the speed of it, I think, is going to be here for a while.
Okay.
And I think it's interesting because we've had a $100 rally since late last week, and it's like doesn't even register as anything. And a $100 rally used to be a huge deal and used to take 3 or 4 months, and sometimes that was the entire trading range for the whole year. Yeah. So I mean, I'm guilty of it, but like this, it was a $100 move, 20%, 500 to 600, you know, specifically looking at futures, but it's like you've kind of become pretty numb to the volatilities. So I think you're right. And then I if you don't mind, I want to ask Mike to clarify the supply chain being in sync. you're saying like there's less even distribution of lumber piles, and it's all on one side, and the buy side is very lean, and then then the buy side gets heavy all at once, and we're kind of in this back and forth.
Yeah. So, markets rally when people build inventories and order files get stretched. And then markets fall when they work those inventories off. And we just had that massive build, we worked it off. And, you could say we potentially are at the bottom of the market right now. Yet this absolute price is one of the highest prices in history. If you look at the Commitment of Traders report, which is a data point put out by the CFTC, the Commodity Futures Trading Commission, I have never seen a lower number of industry shorts than we have right now. I think on Friday it was like 117, something like that. The industry is just not hedged. The industry has zero concern for lower prices right now. They think the prices are all going higher.
And that's what we often refer to as smart money, right?
Well, it's smart if it moves in their direction.
Yeah. I mean, traditionally, like the commercial hedgers, as registered with the CFTC, are in the cash markets. They're seeing trade flow of the cash markets, and if they're in the futures market, it's because they're seeing something different in the physical market than they're in the futures market. So they'll take an offsetting position. And I haven't paid attention to it. I didn't realize there's such a minimal short position, and that's producer too. The producers aren't hedging production, if that's the case as well.
Right. Well, and there hasn't been an opportunity for traders like you to put wood on the ground and hedge it, for that matter. So right. Right now I think we are at the on-ground inventory. This is just a guess. I have no way. There's no way to measure it, but I would say the on-ground inventory is probably light.
Yeah, I'd agree. Which is a very particular side of the boat. So if there's a railroad strike or some other supply side pinch or bullish development, there's just susceptibility because there's not a lot of inventory spread out throughout the supply chain to get people through to the other side of some kind of price fight.
Well, and then along with the industry not being short, the industry is long, meaning they have bought wood. They just haven't bought physical wood.
Oh, they're long futures. Yeah. Okay.
Yeah. So,
so guys,
I'm sorry.
Go ahead, Russ. Sorry.
No, that's okay. That's good. So let's, we're talking a national look and even a North American look at the things that would affect the cost of lumber. So what are some of those things that people need to be aware of and take into account that affect the cost of lumber?
I'll jump in there. The number one thing is transportation, the ability to get it the last mile, either to the job site, more so to the lumber yard where it's going to get staged. This rally, in my opinion, in 2022, where we felt like we were on our way up to new all-time highs. We ended up not doing that. We got pretty close. Was logistics driven. We didn't have the rail car capacity. We definitely didn't have the truckload, the flatbed truck availability, the price of diesel, all the things that we're all very aware of. So for me, if I'm looking at anything, if I'm looking at one main thing, it's transportation. So what are rail car speeds? How many rail cars of lumber are getting shipped? And flatbed availability. And that data is out there. But for me, that if I'm looking at with everyone being so lean, if they wait till the last second to order lumber, and there's trucking issues, and then maybe a big buyer steps in and sucks up some lumber, that causes you issues, because I don't think we have a production of lumber problem anymore. So these bottlenecks and the volatility is going to come from transportation issues. And we get some fairly good high frequency data on transportation. And right now it's pretty loose and smooth, and prices are coming down. Price is one thing, but it's just the scarcity that can happen in truckloads, flatbed availability. So that's the number one thing I watch. And for me, I'm watching railroad flows from Canada to the US, because if that gets caught in a polar vortex or a union strike, if you need Canadian sourced wood that's going to go via rail, you will not be able to get it. And it's just the reality of lumber's last on the list of priorities for rail lines. They hate shipping it, and it gets literally sidetracked. And that's what's going to gum up our system. And that's what happened in Q1 of this year.
Well, Stinson, it's interesting you say that. I'm looking at an email just got today that a Canadian mill alerted us that the CN Railroad is not granting any permits on shipment to the West Coast at this point. So they're not providing any rail cars.
Yeah, it's hard to fathom. I remember when I got in the business, I started in the grain desk, and they're like, you got to watch out for these railroads. They legacy companies and monopolies, and you're not building more railroad, more capacity. There's no competition. Okay. And it's hard to fathom. You get an email where your supplier's like, nothing I can do. I can't even ship it to you. Like, there's just no way around it. It's bizarre, and it's hard to comprehend and believe unless I've gotten the same notes. I'll buy a rail car and say, all right, I need to send it to Dallas. I'm like, oh, we're not shipping to Dallas. Like, what do you mean you're not shipping to Dallas? I'm like, okay, fine, let's go to Atlanta. Not shipping to Atlanta either. It's crazy.
By the way, you own the car.
Yeah. So give us a destination. That's not the two major housing markets in the country. So
You can send it to anywhere you want as long as it's Chicago.
Yeah. Mike, what do you think are some of the other factors affecting the cost of lumber, or that we should look at for next year?
Well, Stinson's talking he's a little myopic. He's very in the short term there. I'll take a stab at a little longer term,
Okay.
which is fun. Going back to economics, 101, supply and demand. And if you look at the demand side, what drives demand is household formation and interest rates. So, why did we use so much wood up in the previous 2 years? Because we had created all these houses over the last 10 years, households, I should say. We created households. We did not create houses for them. And then we threw on top really cheap money.
Mm-hmm.
So on my previous show that I was doing with Greg Kuda, he showed a chart where in beginning of 2020, rent versus mortgage rate was basically on top of each other. It just made more sense to buy a home than to rent. It's totally changed right now. Now it makes more sense to rent than pay for a mortgage because interest rates have gone up. Now we're still creating households, but you can actually shrink households when things get so expensive that rather than two guys living apart, they decide let's share a place. Now you've just dropped the number of households, but so it comes down to expense of the living expense. Where are you going to put a shelter over your head? That's demand side. On the supply side, you have to look at how much production's going on. And right now I'm looking at the US South, and like 2 sawmills have recently started up in Mississippi, Mission Forest Products and Beaver. And you see upgrades to all these sawmills in the South. So you've got production coming out of the South, absolutely increasing there. Then you look at Western Canada, production's going down, and it's probably not coming back. You take a look at Europe, and the thing to remember, the supply demand is a very delicate balance, and it doesn't take much of a shift to drive prices in one way. And lumber, you would think, is going to be more elastic, meaning it would balance itself out, but it doesn't. It gets shifted and then it just runs that way for quite a while. It's a trending market. The Europeans had come to the market pretty strong when prices were good. If prices get bad, you could see these Europeans just go away. Okay. And it's a pretty sizable chunk of wood. If it's, let's say it's 3% of the consumption, 3% can tip a market.
Yep.
Good point. What about engineered wood? Is that a viable alternative? Is that what do you guys see on the engineered wood front? Meaning I-joists, LVLs, that kind of thing.
Yeah, I think being in the industry, engineered wood was kind of and still is what would hold up a bunch of job sites. The headers, the beams, and the style of the homes we build require those. And I kept asking, I don't build. I don't know how to build a house. I barely know what the stuff is used for, but I know what it costs. And I kept saying, like, what did we used to do before we had LVLs to span this huge living room? And the answer was, well, we just didn't have huge living rooms. Or we had a 2x10 or 2x12 Southern Yellow Pine that had a squeaky floor, when it was all done. And Mike, I don't know what you're seeing out there, but engineered wood seems to be this great product, this great solution, but it's a manufactured product that was not ready for a prime time pinch in demand that we had, and it couldn't ramp. And it's a whole years long process to ramp production there. So to me, it's inexpensive compared to all the other loose lumber, but it's a huge pain that holds up entire job sites as we wait for engineered wood.
It's inelastic. Like you said, you can't ramp it.
Yeah.
And I think we'll probably touch on this later too. The lack of communication between designers and the job sites and the availability, like the supply chain. We've never heard the topic supply chain discussed more than we have in the last 2 years. Yet do the people that are designing these structures have a good grasp of it? I mean, I don't know. It seems crazy to me that you wouldn't design something with flexibility in it that you could make an alternative choice, be it go steel or solid sawn, like you're referring to, Stinson. I mean, it's an amazing product. And what I think is going to happen 10 years from now, there's going to be a different engineered product. I have no idea what it's going to be. Like, we're going to answer the call for this, but in the short term, I walked through a house in Chicago. I guess it was this spring, and the guy was putting 3 2x12s together because he couldn't get engineered wood. So he was old schooling it, right?
Yeah. Well, and that inelasticity, it was interesting to me as a lumber trader, trading as high as the market can bear when I own it and trying to buy as low as possible when I'm trying to buy it. Engineered wood isn't priced that way. It's not priced like a commodity. And instead of raising price, they do what they call allocation, and they just give each customer some kind of quota based off of prior usage, and kind of service their best customers. And tough luck if you have more volume than your quota, or you're in a new market or something like that. But it was interesting to me because I lose money on trades all the time, so I can confidently say, I would rather you raise the price to get of engineered wood to the point where folks are saying, no, we'll find an alternative, versus saying, we'll put you on the list. We'll put you on the back order list. It just seems like a less efficient model, but I'm not in charge of pricing engineered wood, and that would be a very different way. But the way we got through lumber is the highest bidder won. And if you needed it bad enough, you could get it. You just had to pay the price. If you need engineered wood badly enough, doesn't matter. You can't get it. There's no number that you can pay to get it. And I just think that was an inefficient way to get that done. But it's still tight. I think there's going to be investments. It's just going to be too little too late. And we'll have a bunch of spare LVL capacity when we don't need it as much.
And to your point, Stinson, the pricing drives species swap, product swap, all that. And we're seeing that with Southern Yellow Pine and SPF, but you're not seeing that with EWP. And as a person who spent most of my career in the dealer world, it was amazing when things would be spec'd out that weren't available or weren't even available that region. And architect was from a different area and he's in the South saying, I want all Doug-fir studs. It's like, hey, come on.
Yeah, I've come across some of those too. And to Mike's point, the lack of communication has been exposed because now you're going vertical and you got guys on the job and they're all waiting on some specialty spec that the engineer stamped, and it's across the country, and you got to pull a bunch of strings to get some approval to get a different spec. So that pre-planning process, I think there's money to be saved in working with folks on the front lines who buy the product, supply the products, and further up in the design process. And you mentioned, Russ, the species switching. That to me is the biggest development over the last 2 years. I came into the business and my impression that I got was Southern Yellow Pine will never be used as a stud. It will never be used in certain markets. It's all Canadian spruce. It's the best, and we'll never switch because pine is heavy, it's dense, it twists, it's hard on your saws, your nails, all this stuff. It's inefficient. You can't production build with it. Well, when the price gets like $500 per thousand different, people like, oh, maybe we can take a look, because if it can get here on time and we can throw it up, let's try it. So I think the market share of Southern Yellow Pine had this chance to grow because it was available when spruce wasn't. Spruce was stuck in Canada. Mike talked about what are likely to be permanent reductions in Canadian spruce production, while we have this huge improvement in the US South in the production of Southern Yellow Pine. And I've just personally seen and have trafficked in way more Southern Yellow Pine than I ever thought I would. And it started because it was frankly available. And then it was like, yeah, this works. It's not your grandfather's Southern Yellow Pine. It's produced a little bit better, a little bit straighter, a little bit drier. So I think that's been a positive shift because it's allowed builders and end users to have more flexibility than having that rigid Canadian spruce only, which I didn't see coming, but 2 years after the fact, I'm definitely on the side of pine as a viable and consistent alternative to Canadian spruce.
And I'll play armchair quarterback on it, of course. Are we shocked that West Fraser and Canfor and Interfor are some of the biggest sawmill owners in the US South?
Yeah.
See, these are three major Western Canadian companies. Now they're the biggest producers, some of the biggest producers in the US South.
Yep. They figured
So, and that started 10 years ago, right?
Right.
And we were like, oh, they're just chasing the cheap logs. Well, they were, but the logs were cheap because they were there and the logs weren't in Western Canada. The thing that excites me actually about the tightness of engineered product is the word engineered. These are the nerds that are going to figure out a better way to do something. Like, who would have thought that we would actually have a wooden I-beam 25 years ago? In fact, I distinctly remember trying to sell some of this stuff in Chicago, and they were like, no, get that crap out of here. Just give me 2x12 white fir.
Don't you remember it was marketed as a 2x10 with a handle on it?
Yeah. So I think what you're going to see is new styles of building this, offsite, and just figuring out new ways to do stuff. Because hey, if engineered products had the flexibility and elasticity that Stinson was talking about, they would have dominated and basically taken over. But they just haven't quite figured out how to do that.
All right, let's talk a little tactical now. I'm sure that's what a lot of people want to hear. So what's Mike, you start off. What strategies should lumber dealers use to protect themselves when bidding projects for next year? One that comes up is mill contracts. What's your thoughts on that? We'll kind of get that one out of the way first.
You couldn't sell me a mill contract with a bow on it and $100 million. Like I guess 100 million, but it comes back to flexibility. So as you know, I've been a trader basically my whole life. What I hate getting is put into a corner and tied up. Like, give me the flexibility to switch species, to change up my shipping methods, you know, go to a different region. Mill contracts, in my opinion, are absolutely idiotic, especially when we tie them to a price that we don't know.
I eat random lengths.
Whatever you want to price it to. If you are telling me today, here's what's going to happen. You're going to take this product on this date and you don't know the price. How does that sound? Well, yeah, I mean, if you're worried about running out of something, that sounds great. But if you're worried about managing your profitability, that sounds horrible. You're getting something shoved in your yard. So I'm not a fan of mill contracts, as you could tell.
Stinson, do you think you could be a little bit more specific and opinionated than Mike on this concept?
Yeah. When I came into the industry, I came in as a risk management consultant at a firm that's now called Stone X. And I consulted the lumber industry on using lumber futures and options to manage their price risk. And it was so confusing to me when I'd walk into a place and they'd say, yeah, we have contracts on with the mills. And getting a better explanation, it was, we're getting a supply side contract, a volume contract. And the negotiation is how many, what's the volume we're going to send you? 10 a week at Print Plus for 3 months starting this month. Maybe you could negotiate your adder above print, try to bring that adder down. But largely, I couldn't understand. It's like, okay, so you're buying lumber, you're locking yourself in to be long lumber at the whatever interval, and you're basing it off of prior analysis of your seasonal needs. But what if your projections are wrong, or you need more, or you need less in that same time frame? And the point I was trying to make to these folks was, you can't go long or short print. Like, you can't hedge yourself on what print is going to do. And contracts are kind of, I think, a win-lose. It's just, if it's going up, you're a winner. If it's going down, you're a loser. And the other side, what's good for you is bad for the other side. There's always this weird conflict, how much you're going to take and when you're going to take it. And you can't back out of the contract. And the concept was, we always just need to be on market. And that's why people do Print Plus. If we're buying at market, we're going to be fine. And if we turn our inventory quick enough, we'll dollar cost average up and down and be okay. The problem that Mike pointed out is the flexibility, and the you're not really managing any price risk. And I just don't see, and this would be a change from previous cycles. I just don't see a supply side pinch moving forward. I mean, we had the mother of all supply side issues, and I think it's largely sorted. And there could be some residual emotion tied back to that, like the railroad strike potential's got the market on the edge of its seat a little bit, like what if, and like $2,000 and all this stuff. I just think we've smoothed out the supply chain. So this idea of like, I'm going to lock in supply, I would put that as a second priority to managing your risk. And the volatility, to Mike's point, it's going to be, we're going to trade in wider ranges than pre-COVID. Not quite as bad, I think, not quite as bad as we've been through the next 2 years, but still a wider trading range than any of us have operated in for any length of time. And you can't go long print, or go short print. So if you have a contract that's Print Plus, and prices are going down, your sales are going down, your future business is going down. You just have to eat it. There's nothing you can do.
So Stinson, just to clarify what you said, when you say go long print, go short print, you can go long a futures price and short a futures price, but print, meaning random length, does not necessarily follow the futures.
Well, this is the hook on print. By the way, I truly believe that they are the individuals that publish pricing, whoever they may be,
Great
high
American
integrity.
These
They operate with a high level of integrity, and they do exactly what they say they're going to do. They will publish the last sale at a mill. Well, if a mill has a 5-6 week order file and then they don't sell anything for 3 weeks and they report the last price they sold at for 3 weeks in a row, that doesn't seem so good.
Yeah.
So, what I, and Stinson's leading right into this, what I think the lumber industry should do, much like many of the other commodity industries, is tie their contracts to the futures market, which gives the buyer the ultimate flexibility to actually buy a futures contract and lock a price in. And then if they own the futures contract and the prices are falling, they could sell that futures contract and allow the prices, allow the market to move lower without being held long. If you look at any other industry, they have basis, and they do, instead of print plus, they will do futures, plus or minus, delivered to the, like in a grain market, delivered to the local elevator. So it's kind of the same concept of securing supply, but you are allowing yourself the flexibility of hedging your risk or not hedging your risk.
Yeah, you can actually do something about it. If you anticipate print, and yeah, I have no qualms with print. I think if you read the nuance and you read the color behind the number, you get the nuance of what they're actually reporting. And when you need pricing discovery the most is when print is at its most disadvantaged, because order files are out. There's a lot of nuance between what's the last sale versus if you needed it tomorrow, what's the price, versus if you could wait 3 weeks, what's the price, and what gets printed. So there's nuance there. You can't just look at the number in any particular week and assume that's where we're buying lumber at today. Depends when you need it.
And what I want to talk to real quick, sorry to interrupt, but I think this is important. It's the year 2022, and random or print is a look back. And sometimes it looks way, way back. Like if I told you, oh, hey, go over to that gas station and fill up your tank with gas, but the price you're going to pay is what it was 3 weeks ago. And you're like, yeah, but the prices have fallen. Yeah, sorry. It's just the way it is. Like we live in a world where we want instant information and instant data. And this is shameless plug for Materials Exchange, but that's a place you can get instant data. Shameless plug for Stinson Dean. If you want to know what the price is, he can give you a price on wood today.
Right, and that doesn't get printed, and Random Links print is, they don't claim to be that. And again, you got to read the nuance. What I would call, Mike, what you're laying out is a spot price.
Yep, of course, yep.
Right, and spot price is where most brokers make their money. Is you are unaware of the spot price, and I am, and you're looking at kind of outdated data, which could be data from yesterday or a week ago, when the market's moving fast enough and the spot market's moving, and you're the last to know. And it's like, do you have dedicated lumber buying desks that track the spot market? If that's an event that you've made. If not, you can't really expect to be all over the future or the spot market and the daily fluctuations in price. But what a mill contract that's tied to a futures price allows you to take a position on this guaranteed volume. So you're still taking the volume from the mill. You're using a 2x4 futures contract plus whatever adder. It can be for any product that has some sort of correlation to the contract. But the point being is, if you're bullish And you can buy a futures contract today that in 3 months will eventually be your pricing mechanism, or to be futures plus $100, to Chicago or something. And you've already bought in anticipation of those needs. As the fundamentals in your individual business has developed, you can make tweaks and changes to your risk management plan with a futures contract, a mill contract tied to futures, in a way that a mill contract tied to print, you can't. You just take the wood, and there's not much you can do. Where with futures, you can be proactive and take a stance on the changes that have developed since you initially entered into a mill contract. So it provides flexibility. And I think there's this push for folks like, what are we going to do different? How are we going to react to the last 2 years? Supply chain mishaps and product expertise and trust in a vendor, and things got really tight. And it's not to say you got to find out who your friends are, but people just got put in impossible positions all across the supply chain, and you just had to pick who's gonna be taken care of and who's not, because there's just flat out not enough product to go around. And spot market pricing has become more valuable because it's moving so fast than kind of 2 to 3 week lags in pricing as things filter through. So I think folks have made some kind of effort to be a little bit more clued into spot market pricing. If the market's moving, you need to know it versus waiting till the end of the week. And the only way you can do that is really to have some dedicated expertise and follow. The futures market is the only transparent, real-time pricing mechanism that a lot of folks look to. Is one of the biggest individual trading days ever was yesterday.
So let's talk about futures. I want to wrap up on contracts, though. I would say that the 2 reasons I have seen that kind of make sense would be if you're worried about supply, and I think we all agree, supply is not going to be near as big an issue next year. The other one, and it's probably more on OSB where there isn't a futures contract, if you're stuck on a specific brand, I've always kind of maintained, why lock yourself into a brand that's kind of like locking yourself into futures. But some mills, if you want to get that brand, you have to have their contracts. And then the last thing I would say the desire to have futures contracts tied to futures is a great idea. Haven't seen it really been in play yet. I don't know if you have, but that's something
not
we
yet.
probably need to look at. So let's talk about the lumber futures. Let's talk about the changes that just came up on a lumber futures contract. That's probably what a lot of people want to, we kind of went from 50,000 feet down to tactical stuff. Whoever wants to take that first, let's talk about the new lumber futures contract. Some people might not even be aware of that.
I'll take a stab at it, but I'm going to back up just a little bit because I had something I wanted to say about the supply chain. We're not unique in lumber. The supply chain issues are hitting almost every industry, and this is a hangover of just in time.
Yeah.
And what I think we have to accept is if as the middle of the supply chain, which simply connects the supply and demand, if we as an industry want to provide the value add that we do, what we need to do is communicate and open up better transparency. And part of that is we might not be able to maximize our return at all times, but we can provide the level of service to both sides. And one of the thing I think where the middle did a disservice to the supply chain in this last move is when the demand needed longer term pricing, we went shorter term. The demand needed 90-day pricing, we went to 30-day. And this segues into this new lumber futures contract where there is the opportunity to give long-term pricing. So the new contract is very exciting in that it adds my favorite word of the day, flexibility, because it's smaller. It's a truckload contract, and the volume on it is a truckload as opposed to a rail car. And where it takes care of some of the transportation issues is it's priced delivered to Chicago. And it's a product that can come from Western Canada, it can come from Eastern Canada, or Western United States. Unfortunately, not Southern Yellow Pine yet. And how it's, well, Stinson, you could say how it's different than the legacy contract.
Yeah, so the existing contract is a carload's worth of lumber. There's two ways to think about it. That's the equivalent of 4 truckloads. That's how we've always traded it. You can build like 8 houses out of 1 rail car of lumber, which is 1 contract, 1 futures contract. And now there's effectively, we call it a mini contract, where it's traded in truckload sizes. So it's much more apt to your home builder to be able to hedge off a house or 2 houses on 1 contract, where each house is priced differently, and you got this massive futures contract, and it's hard to bundle your hedges. Excuse me, 8+ houses in the 1 hedge. It's not quite as acute to the need. So the new contract was designed to address that, along with, if you're going to take a position in lumber, you don't have to take a rail car's worth of risk. You can take a truckload's worth. So the new contract is 1 truckload the worth of lumbers, 27,500 board feet versus 110,000 board feet of the old contract. And it's delivered Chicago. The old contract was delivered British Columbia, Canada. This is delivered Chicago with the purpose of bringing in Eastern Canadian spruce and Western Canadian spruce, along with Doug fir, to the central point where both those markets compete. So it's opened up the contract to more producer hedging, more producer selling, more producer participation, which should keep a cap on some of the crazy days we had over the past 2 years in futures, because the old contract was written in such a way that only Western producers, Western Canadian producers, could short it and deliver against it. Anyone can short it, but you have to get out of that position and get to the next one, or just get out of the position before it goes to delivery. If it went to delivery, you had to be a Western mill. The new contract is written so Eastern and Western mills can deliver into Chicago, which producer participation is always what you're wanting to incentivize in these contracts. They're the beginning of the supply chain. And so the new contract is better for price transparency, and then it just matches how business is done on a house by house basis.
And I think what you highlighted, Stinson, from the buy side is really important. The previous contract, while it was fun to look at, let's say you're a home builder and you are doing 1 home a month, 12 homes a year. The previous contract was not usable for you. This contract, you could actually use it. You wouldn't have to get 30-day or 90-day pricing from your lumber supplier. You could actually hedge some of your lumber cost or your lumber cost risks with a futures contract. So it brings more people to the party. It allows more people to participate. And what's really cool about the structure of the market is this is all digital. You can trade off your phone. I mean, if you look, I have lumber futures up right here on my phone. You can open an account, like a small home builder or small lumber yard can open an account with TD Ameritrade or with Interactive Brokers and be up and running in in a day or 2, taking care of their own price risk right from their computer or their phone. It really puts the power back into the hands of who's in supply and demand.
So Mike, you talk about like a small builder using it. Small builder would use it as a financial tool. They buy a contract and then they turn around and sell it before it closes. And that's how most of the contracts are being done. What about a dealer that wants to lock in pricing, actually take delivery on the material? Is that a little easier with this contract, or is there limitations on that?
I think it's going to be much easier because previously the the way you were taking delivery was by rail car, which to load a rail car, you have to have a rail siding.
Right.
Now you can take delivery in a truckload quantity. And it will be easier for a small dealer to negotiate with a distributor, wholesaler, even a mill that may not have rail, and take delivery via the EFP, which stands for Exchange for Physical. And it's a great process that it takes away what we call the execution risk, which is trading out of your position. If you're the dealer and you own a futures contract, you're long it, and you negotiate with someone who is short, like let's say Stinson Dean has wood sitting in Kansas City and he's short, and that's where you have a yard in Missouri. You can say, all right, here's what we're going to do. We are going to have truckloads of 2x4 16s go to your yard in Missouri, and the price is going to be an adder onto your futures contract.
And the adder would be composed of freight and then maybe plus or minus depending on the speccing out.
Yeah, it's all in. It's a delivered price. You just say, okay, here's what we're going to do. And then you strike the price of your futures, which means you decide on a futures price. So just do some easy math. If you bought a futures at 500 and the market goes higher, right? So now the market's trading at 600. So you have $100 profit in your futures. Stinson and you come to the agreement that you're going to take delivery of a 2x4 16 into Missouri, and it's going to be whatever the strike futures price is plus $100. So you pay 600 because that was the strike price plus 100. You pay $700 for that truck of 2x4 16s, but you have a profit of $100 in your futures account. So there is some behind the scenes accounting that needs to be done, but the $100 profit will bring your effective price back down to $600.
The way I was taught, if you look at futures, if you're a lumber dealer, you want to look at futures as a substitute mill. So if you're going to buy, you would kind of look at the futures price as a source, and figure out if it's cheaper than what you could buy on the open market. And then if you are a lumber yard and you have more lumber than you think you need, you look at futures as a substitute customer. And you take a futures position in lieu of taking a position with a real customer. You wait for the market to sort itself out, then you remove, you lift your futures position and enter into a real world contract with a mill or customer. Where the EFP process comes is that substitute mill concept. It's effectively a real mill. You got to have the relationships, and you got to know what mill will participate in a EFP, exchange for physical, with you. But once you have those relationships set up and those networks set up, you can confidently take positions in futures knowing this is actually real wood that I'm going to get delivered. And in Mike's example, if 600 works, you should buy that. You shouldn't wait for 500. You shouldn't wait for 400. You're buying 600 for a reason. You're locking it in. And as you go through the EFP process, you'll get wood delivered to you, at 600 plus delivered Kansas City. But that EFP process allows, conceptually, I think it makes the mystery of futures a little bit more simple, and it allows you to utilize futures better than most, in that it's going to turn into physical wood. You can imagine if you're just going long futures because you're bullish price, you don't really have a way to unwind it. You're just at a disadvantage versus someone who's long and they plan to just sit there and take it all the way to expiration and they're not afraid of expiration. Where if you are afraid of expiration because you don't have a plan to get out of that contract, you become a forced seller, and you got to get out of the contract before it expires because you don't want to have a delivery process done, outside of your control. So EFPs are a tremendous tool that allow the substitute vendor part become a reality. It's delivered wood, and you can chalk it up as a PO effectively.
Okay.
And I think that the new size of the futures contract make it the learning curve a lot easier, a lot less steep. So what I would encourage, if there's any interest at all, just try one. It's not going to break the bank. Work with your buying group. I know Do It Best has been the forefront leader of EFPs.
Thank you for the shameless plug, because I was going to say we are one of the largest EFP producer or negotiators, and there's a little bit of a middleman. You got to have people who have relationship with mills that can make it work. But the interesting thing, and you touched on it, Mike, you could not be a mill. You could be a distributor and decide to sell an EFP or do an EFP with a customer out of your own inventory.
Absolutely.
It does open up a lot more potentials that didn't exist before. So
I did the first mini lumber futures EFP last week on that.
There you go. And it might be the very first.
Oh,
Just
yeah. Yeah, that's true.
That's fantastic. Yeah, it's such a good tool. It's so important. When I look at any business operation or, even my own personal trading, I want to factor in as much flexibility as I possibly can, because if you get painted into a corner, it can get really expensive.
Yep. Okay, guys, we got about 7 minutes left. I didn't know if there's any wrap up, or I do know we did have one question asking about kind of a perspective on Texas and the Southwest, if anything we say would change that. The only thing I can think of is the EFP might not be available it is not available on Southern Yellow Pine. So you lose a little bit of that, but Texas.
Actually it is. You can EFP anything.
You're right. You could EFP, you just can't get a contract on it. Yeah.
Yeah. You can, if you have a futures position and then you say, really, I need pine, you certainly can find an EFP. You can EFP it. It's really the quantity. It needs to be truckload for truckload.
So, one thing we kind of glazed over is the futures contract is 2x4, number 2 and better, random 8 to 16, 8 to 20 contract or tally. In spruce or hemford or Doug fir, you can EFP Southern Yellow Pine. What you need to be aware of is what we call the correlation, or the pricing relationship between pine and 2x4, 2 and better SPF.
Yeah, at that point, and that would be the mill that would tell you what they view the correlation as, right?
Well, or you could tell the mill.
Yeah,
like true. This is where I get back to the flexibility. Well, how about you walk through the door as the buyer and you start dictating the terms? You say, hey, Mr. Mill, here's what I'll pay. And the mill goes, well, no, I can't do that. Okay, see you later, buddy. Because now this new contract has all these new participants. I'm sorry, Mr. Mill, I'm going to go talk to Stinson Dean because he's willing to do it. Well, what do you mean? Okay, I'll do that now. Well, so this is the beauty of more participation, is it levels the playing field. So the key is information and participation. You put those two together and what you end up with is a transparent liquid market, which is going to resemble what we see in the financial markets, we see in the agricultural markets. So that for too long, the lumber industry had been held by the select few who control it. And I think this new contract is going to break that free. At least
Russ, JR here on the chat has a question I'd like to answer. He asked, big box stores are affected by both, or how are they affected in both inventory and price? And a great question, because it goes back to our contracts point. And before I speak to it, I got to disclose that I've never been involved in a mill contract, a print plus, with never seen or been in the room or had any direct knowledge of negotiations with big box stores and mills, but it's accepted knowledge that Home Depot, we'll just say Home Depot to represent all big box, are their Print Plus, and their Print Plus with kind of volume commitments. DIY really reared its head in the spring 21 rally. Big box was caught off guard and way too little inventory in 2020. They overcorrected and locked in a lot of inventory in 2021. I remember on Twitter asking folks, like, take a picture of your Lowe's lumberyard this weekend, full of lumber, full of OSB. Meanwhile, the channel that most of us play in, to independent lumber dealers, to single family home builders, custom home builders, if it's at Home Depot, it's not going to a builder who builds homes, and it wasn't moving off those shelves. So now, of course, they corrected again, and I think they've kind of balanced out their volumes. But the mills dictate a lot. But I think what the mills found out is big box dictated to them in a way that they didn't like, and they got kind of stuck with the bill in this latest price correction. So I think we're going to see mills open. It makes them feel good to know we have X amount of production sold at whatever the market is that day. It's sold, but it's sold. We got a destination. We can get it out of there. We can turn it. Well, the reality is, when it wasn't good for Home Depot, rumor has it they just kind of were like, no, we're canceling the contract. So the mills had all this stuff pointed at them, and then all of a sudden they had to reverse and point it towards the open market in a way that exposed them. Like, they couldn't shift all that wood to the open market without raising a bunch of eyebrows and folks knowing they're in trouble. So I think you're going to see naturally the reaction is to hedge their product mix, their customer mix, away from some of these contracts. And I think you could see the Home Depots of the world have to compete in a spot market, and something they're not prepared to do. I think you could see them being forced to compete in spot markets more than they've had to in the past, because the mills got burned so hard by those canceled contracts earlier this year. I think there's going to be a natural reaction to pivot away. Lastly, big box stores pricing, they don't own it until the very last minute. So they are the most on-market, print market type price than anyone else. They have traditionally, they've had a very cushy look back where they can decide what they're going to buy on Thursday night before print comes out on Friday. And they just bring it in out of their distribution warehouse into the store. While it's at the distribution warehouse, it's on the mill's balance sheet still. So they had a very cushy look at the market, and they could kind of pick and choose as they please. But I think you're going to see those one-sided supply contracts get pushed back on.
Okay. Well, we are right up on our 1 hour limit. So I want to thank both of you, Stinson and Mike, for being such good prognosticators on this, and look forward to working with you guys again.
And if I could just throw out there, if anyone has any questions about futures or even how to get started, feel free to reach out to me. I live in Chicago, and I have many connections with the brokers in the Chicago area who we can turn you on to. It's easy. It really is easy. Don't be afraid of it. In fact, those who embrace it will tell you it works.
It's not magical. Yeah, it's not intimidating. So I believe they're going to share all our email addresses. So thank you again, everybody.
All right. Thanks a lot, Russ.
Thank you.